Charles, the market's digesting, on balance, good news from Greece, then a bit of a disappointment and preoccupation again with the Spanish and Italian bond yield levels, those reaching record highs. Today, the FTSE, I see, and I said a moment ago, nearly 2% up. So news digested and a more positive mood.
Yeah, the Greece story, it's not cut and dried, but it looks like we may get the government this week, New Democracy-led. We're then going to see weeks of arguing with Europe over what sort of concessions they might grant Greece. The obvious things to imagine are perhaps a 5-year grace period on paying Greek interest, possibly reducing the interest rate on that debt to 3%. That's what's been talked about for Spain, for Spanish banks, so potentially that could be a way to find a compromise with Greece. But the Germans aren't going to give that away straight away. They're going to want to get something for that. There's going to be negotiations. It's going to take some weeks. But for now, it does look like, yes, Greece holds in. I'm still concerned about 6-12 months out. And I'm not convinced that we've sorted this by any stretch of the imagination. But for now, Greece is enough to put in the background, and it's Spain which is the real focus.
Let's look at what emerging markets should be doing, and the regulators, the bankers, the treasuries, the politicians, in fact, because I suppose in a sense we are spectators, the emerging markets, of what's happening in the developed world, but it's certainly going to affect us, and that point has been made repeatedly. How should the global emerging markets be reacting to the developed world crisis?
Well, assuming that Spain gets a bailout, assuming that somewhat calms the markets for now, we still haven't taken away the risk that in 1 to 2 years' time, the populations of either Greece or Spain say they've had enough of austerity. They've had enough of unemployment being nearly 25%, in which case there is the potential for a big shock. And what the World Bank has recommended a few months ago, what Russia chose to announce yesterday is going to do is start to take precautions against a potential breakup of the Eurozone. So what should they be doing? First, create some fiscal reserves, a bit of contingency fund, so you've got money to intervene and to cope with the fall in revenues that'll happen. Secondly, central banks need to give themselves some room to be able to cut rates if necessary to support growth. Thirdly, potentially building up FX reserves as well. You want to be able to smooth the currency volatility that would come through a big shock like a breakup of the Eurozone. So from here, potentially central banks, I don't think the SARB would do it, but potentially other central banks could be intervening to stop their currency strengthening in the next few months to build up FX reserves. And if governments can build up their own fiscal reserve, if the central banks have got some ammunition, I don't cut rates now, but save that ammunition for when you might need it. And thirdly, build up those FX reserves, then the authorities will be in a better position to weather what would be a very nasty storm if the Eurozone were to break up.
Charles, with the lead up to the Greek election over the weekend, we saw a lot of uncertainty entering the market. We knew that if the Greek government went to the left-wing party, we might have seen a very disorderly exit from the euro from Greece. And we know that would have actually caused a very uncertain time for that country, the country not in any state to build up reserves or generate any reserves from any source. That's the whole reason why they're getting the bailout. Do you think all the rest of the worrying countries in the Eurozone has the same problem?
Well, I think what worries me most about a potential Greek exit from the Eurozone is that it might work. The reason you would do it is to get growth. The reason you do it is to get unemployment down. Those are the advantages of leaving. It certainly wouldn't happen in year one. Year one of leaving the euro would be a disaster for any country. GDP would shrink 5 to 10%. You'd get a banking nationalisation effectively. You'd have a massive default on debt. But after that, what devaluation has generally achieved in most emerging markets is growth, even when exports to GDP are as small as they are out of Greece. And jobs will start to get created. And the damaging thing about that would be what would happen if the Spanish unemployed said, we want jobs too. We would like to see that possibility of improvement. Okay, we know the first year will be bad, but possibly afterwards. And that, I think, is the major risk about Greece leaving, is that in fact Spain were to. And the reason that would be so bad for the rest of Europe is that Spanish debt is huge compared to Greek debt, and far more frightening for the whole financial system.
Charles, I've heard repeatedly the experts talking, saying whether or not the government that's appointed in Greece supports a bailout, eventually, one way or another, they are going to leave the Eurozone. And of course, that would allow devaluation and the effects that you're talking about. So it's a question of not if, but when. Would you agree?
It's much different from...
Would you agree that it's not a question of whether, of if Greece will leave the euro, regardless of which government is in power, but when?
Well, that's we've just been looking at some research this week, and it's showing what's been happening to Greek savings, which just a few years ago were much higher than their level of debt. What that meant was you had a big incentive to stay inside the Eurozone, to protect the value of those savings. But what we've seen over the last 5 years is a collapse in the equity market, down 90% in 5 years. So those savings have gone. You've seen a debt default, so your bond savings have been written off to the tune of at least 70%. And you've also then seen capital flight out of the banks as well. So there's much less to protect now on the part of the Greek middle class in terms of their savings. They still have a fair amount of debt, some 60% of GDP. So the attractions of inflating that away through leaving the Eurozone is growing. It's going to be a very tough year or so. It's just possible they do the right reforms, but I have to say I'm with consensus in assuming that there's a very high risk they go now in the next 12 to 18 months.
That was Charles Robertson, Global Chief Economist at Renaissance Capital.